Ever wondered what home equity is and how you can use it? Buckle up because we're about to demystify this financial term for you. Imagine you're at a dinner party, and your friend John starts talking about his home equity. You nod and smile, but inside, you're thinking, what on earth is he talking about? Don't worry, you're not alone. Home equity can seem like a complex concept, but it's actually pretty straightforward. Let's break it down. Home equity is essentially the difference between the market value of your home and the outstanding amount on your mortgage. It's the proportion of your property that you truly own. Let's use John as an example. John bought his house for $300,000. He didn't have that amount of cash lying around, so he took out a mortgage for $200,000. The remaining $100,000, well, he paid that in cash as a down payment. Now, if we imagine that the market value of John's house stays the same, and he pays off his mortgage bit by bit, he is slowly building up his home equity. Each mortgage payment reduces the outstanding amount of his loan, and that difference between his home's market value and his remaining loan is his home equity. So, after a certain period, let's say John's outstanding mortgage is down to $150,000. The market value of his home is still $300,000. Now, if we subtract the outstanding mortgage from the market value, we get $150,000. That's John's home equity. But here's where it gets interesting. If the market value of John's house increases, his home equity also grows, even if the outstanding mortgage remains the same. So, if his house's market value jumps to $350,000, his equity would be $200,000. So, in John's case, he has a home equity of $100,000, but what does this mean for him? Let's delve deeper. Home equity doesn't just appear out of thin air, it grows over time. But how? Let's explore. You see, home equity is the difference between your home's current market value and the remaining balance on your mortgage. This chunk of change can increase in two primary ways. First, as you chip away at your mortgage over time, your equity increases. Second, if your property value goes up, your equity does too. Let's take John as an example. John buys a home for $300,000. He puts down a 20% down payment. That's $60,000. Right off the bat, John has equity in his home. That's $60,000. Now, every month John makes mortgage payments. A portion of that payment goes towards the principal, the original amount he borrowed. As John pays down the principal, his equity increases. But here's where things get interesting. Let's say the value of John's home starts to rise. Maybe the neighborhood becomes popular, or perhaps he makes some savvy home improvements. Either way, as the value of his home increases, so does his equity. Picture it like a scale. On one side is the remaining balance of John's mortgage. On the other side is his home's market value. As John pays off his mortgage, the balance side gets lighter. If his home's value rises, the market value side gets heavier. Either way, the scale tilts in favor of equity. So, after several years of making mortgage payments and riding the wave of property value increases, John's home equity has grown significantly. Now you might be wondering, how much equity does John have? Well, it's the current value of his home minus the remaining mortgage balance. If his home is now worth $400,000 and he has $100,000 left on his mortgage, John's equity is a cool $300,000. So, John's home equity has grown, but what can he do with it? Can he spend it like cash? Well, not exactly, but he can leverage it. Let's find out how. So, John has built up some home equity, but it's not doing much just sitting there. How can he put it to work? Well, let's dive right in, shall we? John can leverage his home equity in several ways. The first is by selling his home. Yes, you heard it right, selling his home. When John sells his house, he gets to cash in on his equity. It's a bit like cracking open a piggy bank, only on a much larger scale. Of course, this means he'll need to find a new place to live, but if he's planning on downsizing or moving anyway, it could be a good option. Another way John can leverage his home equity is by refinancing his mortgage. In other words, John can take out a new mortgage with better terms than his current one and use some of his equity to lower his overall mortgage debt. This can potentially reduce his monthly payments, freeing up cash for other uses. This option is particularly attractive when interest rates are low. But what if John wants to stay in his home and also wants to tap into his equity? Well, he can take out a home equity loan, which is a second mortgage on his house. With a home equity loan, John can borrow a lump sum of money and pay it back over time with interest. Alternatively, John could opt for a home equity line of credit, or HELOC. This works a bit like a credit card. John can borrow up to a certain limit, pay back what he's borrowed with interest, and then borrow again. This gives John more flexibility than a home equity loan, as he only borrows what he needs. John now has multiple options to leverage his home equity, but each option has its own pros and cons. Let's uncover these in our next scene. Just like any financial decision, leveraging home equity has its upsides and downsides. Let's weigh them, shall we? First, let's talk about the pros. Tapping into your home equity can be a great way to borrow money at a low interest rate. After all, your house serves as the collateral, which means lenders are more willing to offer attractive terms. It's like having a big comfy safety net. Plus, the interest you pay might be tax deductible, depending on how you use the funds. Not too shabby, right? Another pro is the flexibility. You can use a home equity loan or line of credit for any purpose. Need to pay for a major home renovation? Check. Want to consolidate high-interest debt? Double check. Dreaming of going back to school or starting a small business? Triple check. Your home equity is like your own personal piggy bank. But hold your horses. It's not all rainbows and unicorns. There are some cons to consider. The biggest one is the risk to your home. If you can't make the payments, you could end up losing your house. It's the collateral, remember? That's a pretty hefty downside. Plus, there are closing costs and fees to consider. They can add up. And let's not forget about the potential for overborrowing. With all that money seemingly at your fingertips, it can be tempting to borrow more than you need. But remember, you have to pay it all back, with interest. Also, your home's value isn't guaranteed. If the housing market dips and your home's value decreases, you could end up owing more than your home is worth. It's like being stuck in financial quicksand. So what's the bottom line? Well, leveraging your home equity can be a powerful financial tool, but it's not without risks. What works best will depend on your personal situation and financial goals. John now has a better understanding of his options. But before he makes a decision, there are a few key points he needs to remember. Home equity can be a powerful financial tool, but like any tool, it's important to use it wisely. Here are some key points to keep in mind. Firstly, building home equity is not an overnight process. It's a journey that takes time and patience. From making your mortgage payments on time to improving your property, each step you take towards building equity is a step towards increasing your wealth. So, think of your home not just as a place to hang your hat, but as a piggy bank that grows in value over time. Secondly, remember that home equity can serve as a financial springboard, allowing you to leverage it for a variety of purposes. Need funds for home improvements or to pay for education? Your home equity can come to the rescue. But don't forget that borrowing against your home equity means your house serves as collateral. Therefore, understanding how to leverage it wisely is crucial. Now, on to the pros and cons. The benefits of home equity are enticing, from providing a low-interest source of funds to potential tax benefits. However, it's not without its risks. Borrowing against your home equity puts your home at risk if you're unable to repay the loan. Plus, there can be costs associated with borrowing against your home equity, such as closing costs and interest. So weigh the benefits against the risks before making a decision. Lastly, always keep in mind that home equity is part of your overall financial plan. It's not a standalone solution, but rather a piece of the puzzle that needs to fit with your long-term financial goals and circumstances. With these key takeaways, John is now ready to make an informed decision about his home equity, and so are you. Remember, knowledge is power, especially when it comes to your finances.